Hello, my name is Bill Rowland. I help small business owners sell their companies. Before I get started, I need to say I'm not an attorney or an accountant. I don't give financial or legal advice. And this is an informational video only. Let me add, every company will be different, and the numbers in this example are made up. In a real life scenario, there are many more facets and moving parts to evaluating a business than what will be in this short video. What I'm going to go over is a fictitious, simplified version of how small businesses are valued. If we can start on the top line, you can see this imaginary business made $1 million in sales last year. I would like to add a caveat to this. Some business owners think if their company made $1 million last year, it should sell for $1 million. Now the company may or may not sell for $1 million. But first, bankers, accountants, financial institutions, lawyers, and buyers want to see the evidence and the real numbers that support a $1 million asking price. On this next line down is cost of goods sold. This company paid $375,000 for cost of goods last year. Your cost of goods are things like raw materials, labor cost, for workers producing the product, also the factory's overhead and storage. The next line down is operating expenses, $525,000 last year. Some of the operating expenses are rents, utilities, wages, salaries, accountants, legal fees, selling, management expenses, and others. So on the next line down, after we deduct $375,000 for the cost of goods sold and the $525,000 for operating expenses, we end up with a net income of $100,000 for this business last year. On the next line down, where it reads current profit $100,000, is our starting number for what this business might sell for. It is a real viable number that comes off the taxes of this company. So once we add the $100,000 profit, we include the first basic add back, which is on this line that reads interest, taxes, depreciation, and amortization, $50,000. If we take the average for a company making $1 million a year, that's a $50,000 add-on. Next line is furniture, fixtures, and equipment, or FF&E. Depending on the level of technology and sophistication of the company, a company could easily have $200,000 to $300,000 or more in FF&E. So we add that also to the asking price of this company. I need to add a caveat for FF&E. There are two schools of thought. The conservative thought is lending institutions. They don't like to add FF&E into the price of the sale, even after depreciation. The reason for this is most banks think that buyers might inflate the numbers. Yet, the business broker, with overwhelming evidence, insists after depreciation, FF&E should be added to the sales price, simply because the new owner would have to replace all those items. The next line down is inventory. Now, the company's inventory might be paid off. It might be worth anywhere from $5,000 to $50,000 or more. So inventory also needs to be added to the asking price for this business. Next line down is non-recurring income expenses, or one-time chargebacks. This is added to the asking price because a new owner will not have these costs in the future. These costs are things like a fire, a theft, litigation, a new roof, new furnace, or air conditioning, which needs to be replaced. So let's say this owner had a $10,000 roof he had to replace this year. The $10,000 would be added to the asking price. The next line down is discretionary earnings, or seller's discretionary earnings. Discretionary earnings are owner's benefit, are things such as owner's salary, owner's share of payroll taxes, owner's share of pension, auto expenses, auto insurance, life insurance, health insurance, cell phones, unnecessary family members on the payroll, entertainment, vacations, and a number of other things. Once again, for a business making $1 million a year, this company would probably have $40,000 in discretionary earnings. So this $40,000 would also be added to the asking price for this business. The last line on this chart is something called multiples. Multiples takes into consideration things like goodwill, contracts, business name, employees, and a number of other things. In most small businesses, the multiple will be 2 to 3 times the profit for that year, which 2 times $100,000 is $200,000. There is also a thing called risk that affects the price of the business. Since we don't have information on this imaginary business, we're going to skip the risk. So in order to find our asking price of this business, what we've done is, on this new board, you're going to see we got $100,000 profit, $50,000 add-on, $250,000 FF&E, $25,000 inventory, $10,000 add-on for the roof, $40,000 owner discretionary spending, $200,000 multiple times 2. So our asking price for this business is $675,000. Not always, but when selling a business, a good rule of thumb is the business will probably sell for about 60% of your total sales. Once again, this is a fictional business and these are fictional numbers. Every company is going to be different. Thank you very much for listening to the video.